Explain why corporate investment is so messed up.
Well, I mean, there are a couple of different reasons why corporate investment really hasn't been as strong as we would hope at this point in the cycle. Of course, investment usually leads the cycle, not kind of trails it. But one factor was the global economy. It wasn't synchronized. We've got that in place. Another issue was monetary policy. Well, that's pretty much in place. But this gap between the corporate hurdle rate and the cost of the policy rate, the cost of funds, that's a real puzzle still. It suggests that corporations don't really believe that the business environment is conducive to what they want to do. And so we focus on the structural policies to create a more favorable business environment.
Within your outlook, you have this phrase, and it's something I'd never hear out of Catherine Mann or Angel Gurria, inclusive growth. What is inclusive growth?
Well, there are a couple of different ways that you can think about inclusive growth. One is that people within a population, middle-aged workers, for example, that they have more equal distribution of their wages. What we know is that the bottom half of the distribution really hasn't seen any increase in their wages at all over the last decade, whereas the top has done really quite well. But there's another focus of inclusive growth, which I also think is important. That's intergenerational. We have a chart in the outlook that shows that the generation born in the 1970s actually has had a decline in their prime earning years. That's like now. And no other generation since the Second World War has had that kind of experience of a decline in their real household disposable income. So that puts at risk the whole prosperity of the global economy and of course, of those individuals that we're talking about.